Now let's talk about some tidbits about the taxes. So if you own a short-term rental, Airbnb, for example, where you can file your tax return, Schedule C, profit and loss statement, or Schedule E. I would say Schedule E most of the time. Short-term rentals are reported in Schedule E, supplemental income and schedule, the tax form I just showed you, not on the Schedule C. The only exception is on the short-term rental, you report on the Schedule C, profit and loss. If you rent your short-term rental for 30 days or more, if you provide additional services such as you provide like a hotel concierge service. If you have a short-term rental at least 30 days, if you provide concierge services, what they mean, you provide the guests with, for example, with a rental car to use, or you show them around, you do some excursion with them, and then you provide breakfast for them in the morning. Those are concierge services. That category situation, you are in the business. You in the hotel business full time. So that makes you a brick and mortar business, just like any other retail stores. So you provide those concierge services, and you will have a guest who stays longer than 30 days. Then you have to file Schedule C, profit and loss statement. Anything other than that, anything less than 30 days, or when you guest on a short-term rental, Airbnb, most likely you can file Schedule E, just like a long-term investor. A long-term rental investor, they file Schedule E, supplemental income. Does it make sense? We'll report your short-term rental on Schedule C. Like I said, if you provide substantial services to your guests while they stay in your property. But most Airbnb hosts, they don't do that. They do not provide concierge services. They don't provide more than 30-day stay. So those are rare. Right? So which is better, Schedule C or Schedule E? It's not about what form is better. It's which form is the right form to do based on the type of business you have, the type of activities you are reporting. So consult your tax advisor for those issues, so distinctions. So who is eligible for Schedule E? Landlords who own property producing rental income will report their rentals on Schedule E. Yeah. Da-dee-da. What other passive income tax form do I need to know about? IRS Schedule E and Form 8582. Form 8582 is the second page, the second schedule. It is a sort of a passive loss documentation. You have to document every year, or your tax advisor do it for you. So Form 8582 will document your carry forward of passive losses from one year to the other, so everybody can keep track of the year by year passive or suspended passive losses against other passive income you may have. Does that make sense? So we think Form 8582 is one of the most important tax forms for landlords to review on an annual basis, as it tracks your suspended passive losses. Can you group multiple short-term rentals together if you only materially participate in one? And the answer are, you are allowed to make grouping elections per section 1.469-4, subparagraph C for STR, short-term rental, in the right circumstances. So if you own several rentals, if you document the material participation hours, if you want to claim the maximum deduction, if you have several rentals, like I said, then it behooves you to do a grouping election. So if you have a tax advisor working with you, make sure when you file a return, you add this extra tax form stating that you are doing a grouping election or your several rentals on your short-term rental properties. Otherwise, if you don't do a grouping election, you may not get the maximum tax deduction, which is a short-term tax loophole, which I will share that with you momentarily. You got to be very detailed. You got in your claims. You pay attention to detail. Don't neglect important stuff. But we'll get back to short-term tax loophole momentarily. The 100% bonus depreciation has been limited lately. You can only claim, I think, 60% of the bonus depreciation. Bonus depreciation allow you to accelerate some of your depreciation on the current year, like I said, that's a major tax benefit. But the IRS have taken away bonus depreciation to the extent of 3 years ago. You get 100% bonus depreciation on certain asset classes, like a 3 to 5 to 10-year appreciable asset classes within your structure, and do it complete 100% bonus depreciation on that current tax year, which is amazing, huge tax benefit. But each year since several years ago, it was 100%. Then a couple of years ago, it was 80% bonus depreciation, then 60%, and this year maybe I think it's 40%. If there are no tax updates changes, it'll become 20%. You can only write off bonus depreciation. Then a few years later, it will be 0%. So all gone. But there's a high probability, since Trump has been elected, Donald Trump is a risk investor. So he's a pro risk investor, just one thing I like about him. So he may make a plea to Congress and the Senate and pass the bill to bring back 100% bonus depreciation, if not this year, 2025, then 2026. If that is the case, oh my goodness. If that is the case, it behooves you as a risk investor to buy more properties, single-family home, duplex, triplex, multi-units, more than 5 units, 10 units, whatever. Those income property, you can claim certain items inside of the property, the 3-year, 5-year, 10-year write-off components, and do a complete 100% bonus depreciation. So look for the tax law changes coming up toward the end of this year, beginning next year, and then you can make some huge money in terms of tax savings above and beyond the regular returns you're making on your income property, cash flow, appreciation, and debt leverage. You do using a loan, the whole 9 yards. I don't know how many properties you guys own, but income property is the world's greatest multi-dimensional real estate asset class, and income property is the most tax favored asset class in the world. Capish? Understand? Comprende? All right. So the key is you could find a way. There's a massive tax saving opportunity for investors to use non-passive losses to offset their W2 income. The key is you need to find a way, and I'll teach you tonight, to make those passive losses, depreciation, paper losses, to offset against your W2 income, against your active income. That is a key to unleash your tax savings, because it's quite limited to have your passive losses to offset only to the maximum extent to your passive income. But if you can find a way to unleash your passive losses to offset against your W2 income, that is the ultimate goal. If you qualify, which I will show you tonight. All right? So once I show you those advanced strategies, you have to make a determination, giving your unique goals and objectives, your tax situation, your W2 income, the kind of risk portfolio you have, how much time you spend on it, how much time your wife, your spouse spend on it in terms of managing your property, in terms of creating the documentation for quote-unquote material participation. The key is material participation, which is a very advanced, stringent rule. If you can meet the hours with respect to material participation, that'll make your tax benefit above and beyond what you get on a normal basis. So that's the key. If you can document the hours and apply the terminology, the word, the big buzzword, quote unquote, material participation, because that is a huge requirement to do that, to spend the time to qualify for that, the hours you spend and documentation and all that. Because by definition, by IRS definition, income property does not require material participation. Your income property, if you allow your property manager If you allow your property manager to manage your property, you're not material participating the hours associated with your profits in order to maximize your deductions, especially to offset against your W-2 income. Because if you delegate, which nothing wrong with that. My properties are all being managed by professional third-party property managers in various locations in the U.S. So I'm a active participant. I'm not getting my passive losses depreciation to offset against my W-2 income. I don't really need that anymore. I've done that. I've been have gone through the maximum tax status at one point in my life. Yeah, more than a decade ago, I was able to parlay my real estate portfolio passive losses to offset against my earned income. My earned income is not W-2 because I'm entrepreneur, Schedule C. So my passive losses can are offset by my business income, which is just as good as a W-2 income to somebody who have a regular paycheck.